in, sit back and relax. You're listening to the WealthTech Today podcast. I'm your host, Greg Iskowitz, founder of Ezra Group Consulting. This podcast features interviews, news, and analysis on the trends and best practices all around wealth management technology. And this, my friends, is our August news roundup. We've got a whole host of interesting stories, I think 7 stories. And I procrastinated a bit on the news. I really wanted to get out last week, but fortunately I didn't, because just in time for the biggest news of the summer, I would say, which is Vanguard acquiring Altruist. So that got that sneaked that into this news. In fact, it's going to be the first story on this news. So wait till you hear that. And I've got a special guest to talk about that story. But before we jump into that, I want to talk a bit about tech stacks. Most tech stacks for clients we work with don't evolve by design. They usually evolve by accident. You get new custodians, new portfolio management tools, new must-have apps, new AI apps and AI tools. Things are getting much more complicated, not easier. At Ezra Group, we don't sell software. We just help wealth management firms objectively assess their tech ecosystems and make smart, defensible decisions about where to invest and where to stop wasting your money. Our 90-day tech stack reboot gives you clarity without committing to a years-long transformation project. So if you want your tech stack to support growth instead of slowing you down, you need to run, not walk to our website, ezragroup.com, and click the golden, not the golden, that's the old news. Click the big, beautiful purple Contact Us button on the homepage to book a strategy call. I got to edit that out for the next article, for the next ad. Purple Contact Us button. Thank you. All right. Ezra Group, we just make tech stacks better. All right, housekeeping tasks. Please subscribe to the show, yada, yada, yada. Check out our sponsor, Invest in Others Charitable Foundation. And if you're a tech vendor, go to our website, ezragroup.com/register, and register your product for a WealthTech integration score. And let's kick this thing off. All right, and our next story is hot off the presses. It is Vanguard acquires Altruist. Pretty big news. August 26th, Vanguard announced the acquisition of Altruist. If I can bring up the newswire here so I can read this. Altruist combines a purpose-built platform, specialized talent, established advisor relationships, and deep expertise translating advice into better workflows and experiences. Under Vanguard's ownership, Altruist will be even better positioned to help advisors across the industry serve more clients, improve investors' outcomes, and bring high-quality financial advice to more people. Vanguard first invested in Altruist in 2020 to bring greater competition to the RIA custody space. We've had plenty of benefits getting to know the Altruist people, yada, 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 said the CEO of Vanguard. And as more investors in Vanguard funds choose to work with financial advisors, we see significant opportunities to build the strength of truly highly complementary organizations. So to wrap with me about this news story, I have a special guest. It is Parker Entz, CEO of Jump. Hey, Parker.
Hey, good to see you.
Yeah, man, it's been a while. So what do you think of this news? Vanguard buying Altruist. You expected this, didn't you? You had this on your bingo card for 2026?
Amazing surprise. So yeah, a couple of thoughts. I think first, what an incredible next chapter for Altruist. And I think, anybody that's started a company and has kind of worked to try to build something, what a cool story for Jason and the entire Altruist crew, and what an amazing outcome. So I think for them, huge congrats to them. Amazing. I think second, if you're a wealth tech company like us, this is also very exciting because if you kind of go back and look at all of the different technology companies that were started to serve our industry, there's not a massive list of outcomes like this. So this is really special and I think really good for anybody that's building a wealth tech company. And then finally, I think, this is Vanguard saying we're ready to compete in new ways that we haven't in the past, which is pretty wild.
Yeah, I wrote an article just posted on our blog, WealthTech Today. My pitch is that they're really not buying a custodian. What they want, what they're paying for, and then by the way, they're paying $4 billion. So that I left that out of my intro. $4 billion to buy Altruist, a minimum. I think this was a range between 4 to 4.6, so it could be even higher. They're really buying Hazel, right? They just want the AI part of this, right? They're already custodian. They don't need custody, right? They're one of the largest in the world, right? They've already got smart people. What they're clearly looking for is some AI juice. What do you think?
I am actually going to take the other side on this one.
Mhm.
I think, and I don't have any special knowledge of this, but just from what we've been able to tell, the revenue on Hazel is quite small. I think it's great. They've done a great job with it. They've done an incredible job with the PR around it. I think there's few that are as good at PR as Jason, and that's really benefited Altruist like for the last 8 years. But the actual revenue coming in from Hazel, if you were to look at that revenue and then look at that I think it was 4.6 billion, like that doesn't really make sense. So I actually think the story here is Vanguard believes they need the custody business, and the AI piece is an incredible cherry on top and really helps to tell that story. But that's just my opinion. Uninformed.
You're allowed to have an opinion. That's why I have you here, man. But
Yeah.
look at it this way: the custody business, I would guess, is under 100 billion. Would you say?
Yeah, I think that's what people have
It's a guess.
believed, right? It's like,
Because if they had enough, they would be announcing what their AUM is, but they don't announce it. So to me,
they don't announce it. Yeah, they don't feel ready to announce it.
Still pretty low, right? So they're not buying they're not making a lot of money on custody either. They're probably making money, but they're not making $4 billion worth of money, right? I don't know what the multiple is there. I really think that their marketing juice, the fact that they can move the markets and trash all the broker dealers in the space by just announcing a new feature. Vanguard can't do that. Vanguard can announce features all day. It's not going to change anybody's market share, right? Hazel comes out with a new feature and LPL stock price falls 5%, right? You can't buy that for $4 billion anywhere else but from Altruist.
Yeah, I mean, that was pretty wild, earlier in the year when that was all going down. And so there's no question that these large financial institutions have to show technology progress, and they certainly have to show AI progress, or they risk getting dinged for that in the public markets. And so I'd be shocked if that wasn't a major motivator here.
So I have that in my article. That's what I think is a big part of this valuation, because you look at it, and we were talking about this earlier. Bain Capital last year, in November 2024, bought Envestnet for $4.5 billion. Envestnet has 110,000 advisors, 20 million accounts. At the time, 6 point something trillion. Now they're over 7 trillion in assets. 17 to 20 largest banks, 500 billion or 600 billion in AUM on the TAMP side, 4.5 billion. Altruist, a couple thousand RIAs, not a lot of assets, right? Not decent revenue, I'm sure, but $4 billion worth. Where's that coming from? There's something else that they're seeing that they want to get access to.
I mean, I'm trying to think if there's a more successful wealth tech exit. Are you aware of one in terms of kind of
from start to finish? Yeah, in terms of start. Well, now of course, Altruist has taken a lot of money. So
they've raised a lot of money. They've been at it for 8 years. I think they have built an incredible amount of plumbing to be able to run all of this stuff, which is hats off to kind of paying the price to get to that point. I mean, I don't know how many millions of lines of code that they wrote, and most of it was before AI coding tools. That was all kind of.
They see that, yeah. They really know what they're doing.
Sweat and tears coding,
So there was another thing I want to talk about was that something I forgot to put in my article. Robinhood also got into RIA custody by buying Trade PMR. So they saw this as saying, hey, let's take our retail base and see if we can funnel it into wealth management. Do you see, Vanguard already has an RIA business, rather they have their own advisor teams. I can't remember what the name of it is, but they're out there selling directly to clients, higher net worth individuals, fee-based advisory. So they're going to be competing directly against Altruist clients. But do they see this as another way to generate revenue by funneling retail clients over to advisors?
Yeah, I don't know. It's good. It's a great question.
We'll put it out there for the audience to answer. So this is what we got. Altruist is now acquired. The deal is going to be closing at the end of the year or maybe the early next year. And I think that there's going to be tremendous benefits, tremendous synergies, obviously between these two. And I think it's good for our clients because we always need more competition. And even though Altruist was making headway, having now Vanguard's balance sheet behind them can only provide tremendous upside for Altruist to really become one of the big four RIA custodians. Would you agree?
Yeah, I would agree. And huge congrats again to the Altruist team, and good luck getting through the closing. And yeah, I can't imagine the due diligence questionnaires involved there.
Yeah, exactly.
But yeah, amazing outcome, amazing story.
Yep, Salim Ramji, your first big deal out of Vanguard. I think it's a good one. All right, for our next story, we got a special guest. But let me tell you the story first. Morningstar's sale of Bile accounts to Pello won't close. The latest mishap in the aggregation category as Plaid seeks IPO and CFPB mulls plan to permanently allow data fees. Morningstar's plan to put Bile accounts under the ownership and incubation of a Salt Lake City startup is a no-go. This is from RIA Biz, our good friends over there who don't pull punches when they write titles. The Chicago Fund Tracker data company Money Manager sent out an email to RIAs June 25th, informing them of the change RIA Biz has learned from a source who asked to remain anonymous. And to talk about this exciting news is my good friend and industry know-it-all, Jeremy Carnell, formerly head of data at Envestnet, formerly CEO, founder of Trulytics, yada, yada, yada. Here you are, Jeremy.
Hey, thanks a ton for having me. Who the hell is Pello again? I think this keeps coming up.
I was hoping you would know. There's some firm, some incubator thing that came in and wanted to dip their toe into the wealth management water and got burned.
Well, it's interesting, like a company this size and stature of Morningstar doing something with such an unknown, like that right there almost provided some tea leaves, whether or not this was going to go, especially the turnaround on this was 3 months. Mm-hmm. So it had to be, I'm assuming, obviously there's a lot of information we don't know, but given the timeframes of when they announced it and when they expected to close, which again is a mere 3 months, I suspect it was probably a sub $50 million deal. I bet it was chunk change, right?
Morningstar's at $1 billion in revenue, so it would have to be a pretty big acquisition or sale to even impact them at all.
And I think, again, this is all, conjecture, right? Like as far as what we know and what we don't know. I think one of the things that I don't think anyone's written about is that aggregation runs on credentialed and API access relationships with custodians and banks, right? And so many of those agreements, I know this from back in the Yodlee time, carry change of control provisions, right? So even if just a handful of custodians and banks decline to consent to their data pipes transferring to an unknown Salt Lake City holdco, that asset being sold probably, shrinks materially between signing and closing. So I wouldn't necessarily, say that that's out of the question as a potential reason. So
yeah, no. So Pello, according to what I've read, is an incubator startup.
Yeah,
that's all I really heard about them, and they plan to overhaul Bile accounts. But clearly, I think when they got under the hood, either there was something there that they didn't like, or they just don't understand the business really well. And trying to jump into this aspect of it seems unusual if you've never done anything in wealth management to start in data aggregation, especially a vendor like Bile accounts or a product like Bile accounts that's been around 27 years.
Yeah.
Right. So it's a very unusual way to get started in wealth management.
Well, I feel bad for the round trip that the Bile account staff had to go through, right? I think I feel even more bad, obviously, for their customers who I think at the end of the day have to be excited that it didn't go through, right? I think the idea of their data going through, again, to some player that no one knows about probably was not great. So I think outside of the inconvenience and the headache and the pain and the agita that probably came from the announcements, they're probably happy that it settled back with someone like a Morningstar.
Mm-hmm. Right. A name and trust that has been around for a while, and they're much more stable and they know the industry.
Yeah, that's right. And I think the ongoing thesis is that the whole 1033 decision that comes down as far as custodians being able to, or at least the people who own the data being able to charge for the data. The thesis there is that the small players are going to get just destroyed because of that. Now, that goes away a little bit with buy all being parked back into Morningstar, right? They've got means now. But my question to you, my friend, is what do you think about, do you think a Yodlee plus buy all accounts roll up under STG makes sense here? You think that's
right? That's where you start looking, right? Does that work, right? Yeah. And I was just looking at the history. So Fiserv bought Cash Edge in 2011 for $465 million, which is a lot of money now. Then Yodlee acquired by Envestnet for $600 million in 2015, which they then offloaded for a song and a dance last year. So the data aggregation market, and Plaid's having problems. They were evaluated at $13 billion, and then they just took a funding round at $8 billion. They did a down round, which is no one's happy with.
In that buying spree that happened back then, I think buy all was the one that was bought for the least amount, right? Everyone else.
Then buy all was bought for $28 million. $28 million. 2014.
In your bank, that's in your wallet.
The issue is that I think the issue is not that data aggregation is a bad business to be in. I think it's a good business, and that's an area that can provide value. The problem is that you're talking about very old properties, right? Buy all accounts is 30 years old, and Yodlee is also just as old. And from people I heard, we work with a lot of clients that work with Yodlee, and there's still some squirrels and hamsters running on wheels in the back end, when it comes to that. And we weren't really happy with some of the APIs we had to work with Yodlee. So and again, I've worked with a lot of vendors, and we see that one of my favorite sayings is success. The more successful you are, the more tech debt you're going to have. Right? So it's just the nature of being successful and getting lots of clients on your platform that you're going to have a legacy business after a while. I think that people should be racking their brains on how they can make this work, right? So is it a buy all accounts Yodlee, or is it plugging Yodlee into a financial planning tool, or is it one of the AI vendors saying, well, I'll take this, I need the data, or does everyone go, I don't need it, I'll just have Claude build it for me?
Yeah, that's right. So anyway,
let's talk about Morningstar first. So they also sold their TAMP to Asset Mark in 2024. They shut down Morningstar Office, which was a ticket shock. Just kind of like, we're out of this after 25 years. They did some arrangement with Black Diamond, but I think Advizon got most of the clients.
Yeah, I think right after that, like when Morningstar got sold, when the TAMP got sold and Office got sold, I think our friend Kitchis made the point that there was just no need for buy all any longer. Like those were big consumers of it. And so, it had no purpose. Owning the pipes that.
It made sense for them to divest all the software related businesses. And full disclosure, Morningstar hired us for some product strategy a couple times. So we've been under the hood there.
Cool.
On all those products. All right, Gemma, good to talk to you, man.
Yeah, absolutely. Cheers.
Our first story, Bloomberg acquires Canoe Intelligence. Bloomberg has entered into a definitive agreement to acquire Canoe Intelligence, an artificial intelligence-powered data management platform focused on private market data collection and delivery for an undisclosed amount. The acquisition is part of Bloomberg's long-term strategy to deliver data and analytics tools for investors across public and private markets. According to the firms, the acquisition will allow Bloomberg to provide a fully integrated total portfolio view with an automated post-investment workflow for exposure and risk analysis, cash management, and underlying holdings look-through, underpinned by an investment book of record across public and private assets. It also gives the firm enhanced pre-investment intelligence, including fund screening, benchmarking, and comparative analysis, extending into private markets and a converged data infrastructure, with fund coverage and data normalized with consistent fund identifiers, such as the Financial Instrument Global Identifier. It will also feature AI-powered capabilities integrated into Bloomberg's agentic AI conversational interface, which is called Ask B. Now, today, Bloomberg delivers data on 50,000 private funds, 16,000 private loans, in addition to over 3 million private companies. Now, Canoe connects many GPs and LPs attempting to streamline post-investment reporting. It processes approximately 1.5 million documents per month across more than 44,000 funds and roughly 500 institutional clients, including wealth managers and family offices, representing over 11 trillion in assets under service. In 2025, Canoe entered into a partnership with fintech platform Envestnet to automate the delivery of wealth manager data, including notices and statements on alternative investments from Canoe's platform to Envestnet's Tamarack application. So why does this matter? Alternative investments have grown a lot faster than most wealth management firms' op teams can keep up with. So the book that still runs on documents like capital calls, distributions, K1s, and quarterly statements that live on GP portals, admin sites, and inboxes makes it very difficult to manage. Now, what Canoe's doing is taking those PDFs and turning them into structured fields inside a system that advisors already use, and taking all the household reports and cash planning and making them just avoiding any problems where if you miss one notice, you've got a lot of issues. So of course, Bloomberg's got a tremendous amount of data, and adding Canoe's abilities to that seems very attractive to them. Now, Canoe is going to be able to push their data through Bloomberg's pipe, portal collection, extraction, validation, and they have also a delivery hub into portfolio reporting systems that Bloomberg doesn't have. Now, shortly before the deal was announced, we happened to drop an episode with Canoe's own Mike Muniz, which is episode 354 you can listen to. And he talked a lot about how their product actually works, how they have a dual LLM check for all documentation, that they believe they're the Switzerland of alternative investments, that they can plug into basically any source data and plug it into any downstream platform like Adapar, Tamarack, Black Diamond, Orion, or Snowflake, and it doesn't really matter to them. So also what Mike Muniz talked about is Canoe is an AI platform that automates document and data management for alternative investments, and they believe their job is automating the full journey from the GP portal or admin website into portfolio reports. Now, Canoe has a couple different products. One is Canoe Connect, which is the connection layer of the collection layer. It logs into portals, emails, and websites. They claim more than 5,000 sources using the LP's actual credentials and handling the password and MFA mess that every ops team still remembers from sharing spreadsheets and logins. Canoe also has what's called Canoe Intelligence that extracts all the document data, distributions, K1s, capital call statements into structured fields in their system. And they can then digitize all of that by client, not necessarily by fund. So that's they have a lab environment where they're building out new AI tools and folding those pieces back into the core platform. So we also talk about two models. And let's talk about the Tamarack Envestnet pipe. So last year, there was a press release from Envestnet and Canoe about how they are plugging into Tamarack reporting and be able to feed alternative data into household reporting packages instead of having to put some sort of side spreadsheet together. Now, I don't know how many RIAs are actually using this. None of ours are currently using it at the moment, but it does seem like a very powerful tool, and I'm sure Bloomberg would want to keep pushing this. Now, because they've not only bought an institutional document network, they bought access to a lot of RIAs, and Tamarack is one of the leading providers of technology to $1 billion and up RIAs. It's also interesting about Canoe is that they're sort of unique, at least in the Keats's Ezra Group WealthTech map. We have them under investment data analytics and alternative investments. But the other products in their category really don't do what Canoe does. They're more performance reporting, fund research, and some sort of workflow tools. They don't really have the capabilities that Canoe has built out. So it's interesting. The closest rival that's on the map is Arch, but it's in the data aggregation category on our map. Now, they're also skewed heavily towards the wealth side. They have about 800 portals and more than 500 billion on the platform. And Arch has a $52 million Series B that closed in March of 2025. So they've got some funding, and they're a pretty good competitor for Canoe, the Bloomberg Canoe now. All right, so the deal size wasn't announced, but there was an unnamed source on CityWire that put the rumor at roughly 20 times revenue, around 750 to a billion. Not bad for Canoe, and they framed it as Bloomberg's biggest deal since Barra. Now, on our Ezra Group WealthTech Integration Scorecard, Canoe Intelligence has a 6.09, which puts them in the excellent category with 32 integrations, and they are a member of our WealthTech Integration Score Recognition Program, which you can check out on EzraGroup.com. Now, some of the questions I have is, does Bloomberg's acquisition of Canoe push them further up market towards institutional business and away from wealth? And if so, does that give Arch a cleaner run to the RIA channel? Does the Tamarack pipe and Canoe Switzerland positions stay and they continue to build market share on the RIA channel? And how hard will Bloomberg protect them and decide whether Canoe stays agnostic and that the RIAs can look to consolidate through the platform, or maybe they have to go somewhere else? Hey, next story. I've got two stories about Orion. The first one, Orion, a dynamic new account opening, announces a new account opening. Orion recently announced the launch of its dynamic new account opening tool to support digital account opening within the Orion Advisor portal. And this is with Goldman Sachs Custody Solutions. Goldman Sachs is the first custodial provider from Orion that's integrated for this digital account opening enhancement. The end-to-end integration is now available to Orion Advisor Tech clients who custody with Goldman Sachs. It will be available to Orion Portfolio Solutions clients later this summer and to additional custodial partners later this year, reflecting Orion's flexible multi-custodial approach. To support key advisor workflows, Orion's dynamic new account opening provides faster, more intuitive digital account opening experiences within the Orion Advisor portal. A dynamic workflow that adapts based on account type, household structure, and custodian, centralized data capture that eliminates duplicate entries, and the choice of either DocuSign e-signature or a fully digital experience to streamline completion and real-time digital account opening through direct custodial API integrations. Here's a quote. Orion collaborated closely with Goldman Sachs through 2 hackathons in 2025 with one goal: streamlining the account opening process and improving efficiency for advisors, said Todd Bertucci, Executive VP, Orion Advisor Tech. By leveraging AI at the hackathons, we were able to quickly streamline the account opening process and automate key workflows. This is a meaningful step towards modernizing account onboarding and reducing friction where it matters most. So, why does this matter? Goldman Sachs Custodial Solutions, not Schwab or Fidelity, is Orion's first live digital NAO pipe. So custody market share, much, much lower. Clearly, Goldman Sachs does not have anywhere near the share of Schwab or Fidelity, but they went with them first. Now, Goldman doesn't publish their assets because they're really, really low. But we know that, and they're looking to break in. They're in it for the long game, from what they tell us. And Goldman clearly has got the money to feed this and to keep building out this solution for their clients. They bought a company called Folio Investments in 2025. No, they bought it in earlier than that. They bought it a couple of years ago, which was a one of the smaller custodians that they use to then build out their RIA custody solution. And so this doesn't talk about the time, or this shouldn't cost anything. It should be built in for any clients. It doesn't say any other capabilities or when they're going to be launching this for other firms, but we know it should be available now. Now, what's interesting is there are other vendors that compete with Orion that have announced similar capabilities with other custodians. For example, Advisor Engine in January of 2024 announced fully digital account opening with Schwab. So that was surprising because we've written before about sort of how the big custodians, Schwab, Fidelity, and Pershing, don't really want fully digital account opening. They will allow you to do digital account opening up to a point, but then at the very end, they're going to force you to go to their website to finish the account opening. They just seem to do it that way, except for specific, really large, really good clients. Like some of the largest broker-dealers in the country can put enough pressure on Fidelity and Schwab where they can do fully digital account opening, but most others cannot. And I'm pretty sure that none of the major vendors, Orion, Tamarack, Advizon and Black Diamond on the RIA side, none of them have fully digital account opening with Schwab or Fidelity, at least not consistently. So that's still an issue. But Advisor Engine announced it with Schwab back, as mentioned, January 2024, plus a lot of other interesting capabilities. Of course, they're promoting it very strongly and talking about how this is a differentiator for Advisor Engine. Things like they don't get any NIGOs. Rich Kanker, the CEO, was on our podcast, episode 344, which you can go back and listen to, and talking about how they have even iRebal integrations that you can then plug into for clients of Advisor Engine. Now, Orion has got a very, very good WealthTech integration score of 8.61, which is superior, and 118 integrations at last we counted, which was, I think, the highest when it comes to vendors in the all-in-one or portfolio management category. So one of the questions is, when will Schwab, Fidelity, and Pershing start opening up their digital account opening to vendors like Orion, Tamarack, Advizon, and so forth, so that everyone can have digital account opening? It remains to be seen. Okay, second story for Orion is Orion hits 6.6 trillion in AUA. All right, so Orion recently announced they had surpassed 6.6 trillion in assets under administration, which is up 29% since they crossed 5 trillion a year ago. Now, this article, this press release, clearly is they're using their growth in assets to pitch their AI tools, because that's all this talks about. Adoption of Orion's AI native ecosystem continues to accelerate. The firm now supports over 8.6 million accounts and has nearly doubled its TAMP assets year over year to 211 billion. Orion is pushing their Denali AI platform and a number of different options. According to the CEO, Orion CEO Natalie Wolfson, our clients are among the most forward-thinking firms in the industry, and their success is what's carried Orion past 6 trillion. According to Natalie, Orion clients grew nearly 40% faster in 2025 than non-Orion advisors, and we designed Denali to help extend that advantage. She mentioned my good friend Michael Kitces, and Kitces Research has a productivity benchmark that suggests that if advisors fully deploy AI-enabled time saving into client meetings, they could support up to 40% more revenue. That growth potential shouldn't depend on advisors piecing together their own AI strategy, according to Natalie. They are pitching three different levels, three different options when it comes to working with their Denali AI platform. One is called Powered by Denali, which is built-in AI features at no extra cost inside individual Orion products, including Redtail CRM, portfolio accounting, trading, risk compliance, and planning. The second one's called Denali Solutions, which is connected AI customized to each firm's strategy with initial capabilities around proposal generation, portfolio opportunity alerts, prospect prioritization, revenue and fee insights. And third is Denali AI, launched in February at their conference, which is orchestrating AI across the entire firm by connecting Orion and third-party integration partner systems. Now, I have to admit, this is a little confusing, even to me. I've got to see it on paper before I really understand how this all works. Now, we have had some senior executives from Orion on the podcast. We had CEO Natalie Wolfson back in episode 309 last October, and we had Reed Colley, who came in from the Summit acquisition. It's the episode 330, February of this year. So you can go back and listen to those, or I can just give you the quick summary. So what's interesting is, what I noted is Natalie mentioned in her podcast last October that Orion clients are growing 10% faster than non-clients. So a little bit of a discrepancy there, that it was 10% last October and now it's 40%. So I'd like to hear from Orion about that, how they calculated the 40% and where that data comes from. And Natalie also talked about Summit and the acquisition of Summit Wealth Systems, bringing Reed Colley on board, and their Denali Data Lake and their AI-first approach. Now, in the press release, it also mentioned that they grew 29% in assets since last year. And by the way, when I had Natalie on, it was because to talk about their 5 trillion in assets. Now they're at 6.6. The 29% increase sounds impressive until you put it into context, when you realize that the S&P returned the past 12 months almost 20%. All right, so just 9% of that increase is non-market driven. That would be things like Orion signing new clients, existing Orion clients generating above market returns on their portfolios, or existing Orion clients doing a lot of M&A of non-Orion clients, right? If two Orion clients merge, that doesn't increase their assets. But if an Orion client does an M&A, buys an RIA that's running Tamarack, for example, that would increase Orion's assets. Or Orion RIAs, as Natalie said, growing faster on average than non-RIA, non-Orion clients. So now Orion with 6.6 trillion sounds like a lot, but that still puts them only at third when it comes to total assets across the industry, looking at their biggest competitors. Adipar announced 9 trillion in assets. InvestNet at their conference announced 7 trillion in assets. InvestCloud, which owns the APL franchise, has 4 trillion. And Black Diamond last year, the most recent data I found last year was 3.6 trillion, but it's got to be over 4 trillion by now, you would think. So that puts Orion in third place there in terms of, not that it's a race necessarily. I wouldn't say, well, go with a vendor that has the most assets, but it's not bad to have. It's nothing to shake its stick at when you hit 6.6 trillion. It means you're doing something right. And you now have a huge legacy base of clients. All right, so looking at the overall, some of the questions that I have about this is, again, how much faster are Orion clients actually growing? Is it 10 or 40%? Will Orion clients embrace Denali as their single tenant data architecture that consolidates data from across their infrastructure? Or will these most of the wealth management firms start deploying other third-party platforms like data warehouses and other tools, or even build it themselves? We do not know. Every legacy vendor that we talk to here at Ezra Group is saying that they're redesigning their back-end architecture to be AI native. Now, at some point, this becomes table stakes and not just not a differentiator anymore, and we may already be at that point. And finally, will core platform vendors that compete with Orion, like InvestNet, InvestCloud, Black Diamond, and so forth, shift from their core platform offerings to become these more AI orchestration layer tools like Orion's doing with Denali? We'll wait to be seen, and you can check out them at orion.com. Next up, Digit launches an MCP server. Digit, a leading wealth tech provider, today announced the launch of Digit MCP server, a connector built on the Open Model Context Protocol standard that links its enterprise wealth management platform directly to general purpose AI tools, including Anthropic's Claude, OpenAI's ChatGPT, and Microsoft's Copilot. The integration embeds AI natively into advisory workflows, giving financial advisors a live, governed AI assistant that works across every household, eliminating the mechanical work of preparation and reporting so advisors can spend more time with their clients. The Digit MCP exposes the platform's core capabilities as tools that AI agents can call on an advisor's behalf to search, read, and reason over external data sources using natural language. Instead of navigating the platform screen by screen, advisors can ask Claude or ChatGPT in plain language to pull a household's holdings, summarize year-to-date performance, flag mandate breaches, or assemble a client report, and the AI will securely retrieve the live data from the Digit platform and work with it directly. AI tools have fundamentally changed the way we process information and the speed at which we work. They are augmenting the mechanical work of meeting prep and reporting so advisors can spend less time on administration and more time with their clients, said Benoit Fleury, Chief Product Officer and co-founder of Digit. And by the way, Digit is spelled D1G1T, in case you are wondering or you're unfamiliar with the firm. As advisors and wealth managers more and more use Claude and other AI tools to help streamline their workflows, they can use the Digit MCP to access a range of high-impact capabilities through natural language. So this launch establishes the foundation for Digit's broader AI roadmap. The company expects to continue investing in services and capabilities that help wealth managers leverage agentic AI across portfolio management, reporting, onboarding, and client engagement activities. So this came out actually last month. So why does this matter? We're seeing a race to ship branded AI agents across wealth platforms. As you know, at Ezra Group, we have launched our AI Agent for Advisors directory to track these because there are just so many coming out. And the AI agent directory also tracks MCP servers. So we have the Digit MCP server in our database as well, which you can find at ezragroup.com. So we believe that this type of capability will soon replace APIs totally, as everyone really starts accessing their data exclusively through AI and not needing APIs. The old APIs will become old school, kind of like the old Olay, if you remember Olay from Microsoft, object linking and embedding, how they used to be able to try to move data between Windows applications, and that fell by the wayside. Never really worked very well either. Rather, APIs have worked very well for a number of years, but MCP servers are going to quickly supplant them, we believe. So you can check out our AI Agents for Advisors directory, and also we have launched in our directory one of our own MCP servers. A couple of our clients asked us to build an MCP server for Black Diamond, and Black Diamond says they're building one of their own, but we don't know when it's going to be. Could be months from now. So about 3 months ago, we built our own MCP server for Black Diamond so that our RIA clients can get access to that, so they can do the things that the Digit clients can do, such as query Black Diamond's database directly through natural language, looking for different types of clients, performance, summaries of holdings, and so forth. It's really very helpful and very beneficial to our advisory clients who have that capability now that didn't have it before. So we did have someone from Digit on. We had Dan Rosen on the podcast, episode 256, which was September 2024. If you want to go back and listen to that, Dan talked about how Digit is an institutional risk engine that he and his co-founders built after they worked at Algorithmics, and they put it under a wealth UI for multifamily offices. So this pedigree is really why an open MCP matters, providing institutional grade risk data, not a bolted on chat window. So let's see, we got the Black Diamond plug. So the score, so the questions are, will advisors bring their own LLMs to this trusted household data, or prefer AI that's embedded inside the platform they already pay for? Will more RIAs start to build their own tools and want to connect to these MCPs and force more of their vendors to build them? Or will they be happy with whatever AI the vendors are building inside their applications and sort of be more of a hands-on approach? We will soon find out. And the next story, Envestnet announces Envestnet Wealth Trading. All right, Envestnet has recently announced the availability of Envestnet Wealth Trading, a fully redesigned trading experience that helps advisors and enterprises manage portfolios more efficiently, executes trades with greater confidence, and reduces operational friction and streamlining complex trading workflows at scale. Built with direct input from advisors and enterprise clients, according to the company, Wealth Trading replaces legacy trading experiences with a modern, intuitive platform that connects portfolio management, trade creation, order review, execution, and auditability across a single end-to-end workflow. Wealth Trading represents a significant advancement in the advisor trading experience, said Andrew Stavridis, Chief Relationship Officer of Envestnet. Built in close partnership with our clients, it delivers the speed, flexibility, and transparency firms need to support increasingly sophisticated trading operations while creating a more intuitive experience for advisors. The launch marks the availability of Envestnet Wealth Trading across all of the Envestnet platform. Following extensive testing and phased rollouts, advisors and enterprises can now access a fully modernized trading experience that is supporting live trading activity across firms ranging from independent RIAs to some of the largest wealth management organizations in the industry. Demonstrating the platform's scalability and ease of adoption, one national wealth management firm has deployed wealth trading across its entire advisor population of several thousand advisors in less than 3 months. Now, I covered this announcement when it first came out back in when I did my Elevate conference review, which you can check out on WealthTech today. And I was concerned that they had just announced it and it wasn't available yet when they had the conference. So now they're coming through with their promises, which I'm extremely happy about for my clients. Wealth Trading was the headline launch on the main stage, and they said these are not just incremental updates. They said this was a major release, so that's what we're expecting. They said it's a ground-up rebuild, new portfolio management, New trade creation, order review, execution, and audit should be sitting on one process from looking at your book to sending an order. All right. So the proof will be when some of our larger enterprise clients move on to this platform and we see how well it operates in a production environment. So this was on Chris Todd's Envestnet new CEO Q4 2026 ship list. So they got it out the door. Now, the new trading desk really isn't the interesting part. What I really think is the most interesting is advisor traded sleeves. So this is something that Envestnet has been working on for a while, and some of our larger enterprise clients who depend on UMA have really been beating the bush for this feature. Advisor traded sleeves with multiple levels of discretion in a single UMA account. This way, the home office can trade most of the accounts holdings, but they can pull off one sleeve for advisors to be able to handle and trade. So I interviewed a number of Envestnet senior executives, which you can hear the podcasts earlier. For example, Molly Weiss, before she left 2 years ago, we were talking about these sleeves, these UMA sleeves for advisor trading back then. So now it's just coming out. Now, I'd like to see this adopted at a more quicker pace. There's some things that Envestnet is building that maybe aren't getting adopted as quickly as they would like. For example, at the conference, the Elevate conference, they were talking about how they've changed the way they raise cash, and they have a classic cash raise or raise cash function, and this new tax efficient cash raise function, raise function that shipped last year. However, clients or advisors are still using the classic raise cash, even though it isn't tax efficient, at almost 1,000 to 1. So that's something that Envestnet needs to start encouraging their advisors to work with. Now, we would put this up against Orion Eclipse for our larger enterprise clients, and we have done extensive writing. We're probably going to do a review comparing Orion Eclipse to this new Envestnet Wealth Trading and see how they stack up. Of course, there's also Tamarack as a platform for trading, so there's a lot of options available for advisors. So we're going to do a full shootout of those platforms in the near future. Now, one thing that people don't really talk about anymore is Envestnet Portfolio Dynamics for about $200 million in cash run in 2017. One of the big reasons they bought them was for their advisor traded optionality and the ability for advisors to have much more advanced trading capabilities. And I think they finally put the nail in that coffin with this new release. I think they've finally replaced all the functionality that there's some clients that are still, I think, running on Folio as a platform, but now they'll be able to move off of it with this new Envestnet Wealth Trading system. So some of the questions I have is how fast can they move large enterprise clients onto the wealth trading platform? They said, I've heard many months it might require it to do that. So I want to see that some tools and technology launched that makes it easier to do that conversion. Now, they only have 7 firms live that they've said on advisor traded sleeves. So I want to see more firms move on to that. And will Envestnet, this rebuild, make them place advisors who actually do their own trading, or will the overlay engine, while advisors are making their trades, live inside of some other third-party OMS? That remains to be seen. All right, another story for the news this month. Nitrogen launches Insurance Center. Nitrogen, an AI-powered suite of products for financial advisors, recently introduced Insurance Center, built to give advisors a structured way to assess a client's coverage needs, including life insurance, long-term care, and retirement income. Insurance Center is anchored by the coverage number, a scale that compares a client's existing coverage against their calculated need and gives advisors a clear starting point for conversations. Insurance Center is designed to do for insurance conversations what the risk number has done for investment conversations. Turn a vague, easy-to-avoid topic into a single figure advisors can use to start the conversation. The insurance coverage assessment collects household, life insurance, and long-term care details and calculates the coverage number. A number below 100 may signal a gap, whereas a score above 100 could point to excess coverage, and 80 to 120 is on track. I believe the highest insurance coverage number is 200. So a little bit different than the risk risk number, which only goes to 100. The coverage number is built on established benchmarks. Life insurance need uses the DIME framework, and long-term care need draws on the Genworth Care Scout Cost of Care Survey, which tracks more than 14,000 providers and is refreshed annually. Insurance sits right next to risk and tax planning in almost every serious financial plan, but most advisors don't have a quick way to show a client exactly where they stand, said Justin Boatman, Chief Marketing Officer and Head of Product Strategy at Nitrogen. Insurance Center gives the advisors that same swivel the monitor moment they had already with the risk number, but now for life insurance and long-term care. So I really like this, and I sat down with Mike Betts from Nitrogen a couple of days before they launched this new product at LPL Focus, and they've got six centers, right? So 6 of their products now is in this Nitrogen suite: risk, investment research, income planning, legacy, their tax planning, tax optimization, and insurance. That's 6. So I think that's quite a wide range of capabilities for them. Now, what I really like about this is, in general, advisors need more tools to offer what we're always talking about, which is holistic wealth management. And there's not enough advisors who do that. Insurance is a big part of holistic wealth management. And there are a lot of products that provide insurance information. For example, all the major financial planning tools have some insurance coverage, insurance information. But I think I like the way Nitrogen is doing it with their coverage number. It might be oversimplifying, but people need that because it is very complicated. No matter what kind of insurance you're looking at. So having one number that at least they can hold on to as a client, because I always say we live and breathe all this stuff day to day. So we understand all this stuff implicitly, whereas the average client, it might take a little bit longer to get them to understand how this works. So I got a demo of the entire product end to end. I really like it. Of course, there's always some things I would want to tweak. This is only version 1. So they're doing long-term care, life insurance, and annuities. And, so that's a pretty decent coverage. And there was some technology or other technical terms in the platform that they're walking clients through that I thought maybe could be put in more layman's terms. But according to Mike, that they've designed it for the advisor to walk the client through. So a lot of the terminology is kept in advisor speak, which I tend to not like. But I've been on this soapbox quite a long time about holistic wealth. And one of the things I mentioned to Mike, and I've written about this, is that I think a lot of this stuff, a lot of the questionnaire-based processes that we use, especially our risk tolerance and things around insurance, really don't work that well because people don't know what to answer, right? People don't really understand, even if you explain to them when it comes to risk tolerance, what the right answer is and how they would actually react if that happened. And so I wrote an article, I think 10 years ago now, about how I thought big data, that's what we called AI back then, big data, would replace risk tolerance. Because if you look at how people react, their social media, how many trades they make if they're self-directed, that tells you a lot more about how someone reacts if the market goes down or crashes, God forbid, than what they answer in a questionnaire. So I thought that's something that we really need to look at. But I'm digressing. Let's go back to Insurance Center. So I really like this. I think it's a great idea. I think it's good for Nitrogen to get more expansive when it comes to a holistic wealth management. So they've launched it at LPL Focus. I think the pricing for this is $100 a month for standalone Insurance Center. And according to Dan Zitting, Nitrogen CEO, he said the rest of the platform price will not rise. So that's good for Nitrogen clients who want to add Insurance Center to their product mix. I had Dan Zitting on the podcast, episode 307 last fall, and Nitrogen Wealth on the WealthTech integration score is an 8.74, which is superior with over 40 integrations. So you can check them out if you're looking for a well-integrated product. So a couple questions. So how does the coverage number and the risk number work? Do they integrate well? Like clearly they're very different numbers and they're looking at different things. You also got the nitrogen GPA. So a lot of different numbers. Is there one more number that kind of summarizes all those numbers, or do you have all those numbers together? How do we work on that? Will there be a self-directed way for clients to run through these insurance processes themselves, or is it only advisor-based? And what's the next steps for Nitrogen's overall suite? What's going to be the seventh product that's coming in? We'll all have to wait and see. Hey, now we're to my favorite part of the news. It is the Keatsis Ezra Group Advisor Tech Map updates and the WealthTech Integration Score and the AI Agents for Advisors Directory. Got a lot to talk about. This month, for the September Keatsis Ezra Group Advisor Tech Map, we've got 14 new products. Whew. Man, I've got a total, I'm showing 635 products on the map. That is tremendous. We've got 14. Let me just run through these as quickly as I can. Starting off with tax. 2 products in the tax category. One's called Stratum. It's tax optimization software that models Roth conversions, tax loss harvesting, Social Security timing, and structure withdrawals together. So you see the combined lifetime tax impact instead of each strategy in isolation. Includes AI extraction, of course it does, from tax returns and client-ready presentation output. It is Stratum Tax, StratumTax.com. Next tax tool is Retire Tax. Oh boy, Retire Tax Scan Pro. Takes a completed tax return plus a short household conversation and produces 10 independently scored retirement review areas ranked by priority in a client-ready PDF built as a first meeting value demonstration tool, $500 a year. RetireTaxScanPro.com. Okay, AI assistants and agents, of course, got to have some of those. Strata AI communication and compliance platform, morning briefs, meeting notes, follow-up emails, client intelligence, statement parsing. It's in the AI assistants agents category, strataai.org. Why is that .org? Why would you do that? Advisor Claw, private AI infrastructure for an advisory firm running on the firm's own server with persistent memory, advisor-specific workflows, and curated skills. The pitch is AI that lives inside your firm rather than a generic chatbot. Pricing starts at $500 a month. AdvisorClaw.ai. All right. Client meeting support. Synopsist. Synopsist? Synopsist. Synopsist. Automated meeting summaries. Oh, we need more of those. That roll into a living client record, tracking action items, decisions, and open tasks across multiple meetings. Branded executive summaries in under 30 seconds. That seems kind of a long time. Aimed at advisors, CPAs, and insurance agencies with audit trail requirements. Synopsist.ai. Take my advice if you're looking to start a new company in the wealth tech space. Meeting summaries and meeting notes is not the place to do it. Trust me. Prop gen and sales enablement. Tie out IQ, not timeout. Tie out IQ. Upload a prospect's brokerage statement PDF, and it verifies every holding against the stated totals, analyzing allocations, fees, concentration, and embedded capital gains, then generates a client-ready proposal, targeting RIAs with 1 to 10 advisors. TieOutIQ.com. Also Prop Gen, ArvoFin, ARVOFIN, converts investment statements into branded compliance-ready proposals. Did we just say that? Yeah, that's what TieOutIQ does. We got 2 products, the same thing. Then tracks engagement, which pages clients read, how long they spent on each section, when they came back to it. Arvofin.com. It seems like these are tools that advisors are building because they can. They're saying, hey, I could just go to Claude Code, I can go to Codex, I can build anything I want. And if I want it, someone else might want it. Well, that's not always the case. And we're just going to get flooded with more of these point solutions, one-off tools to no end. I can just see it. It's already happening. Investment portfolio rebalancing, Stock Alarm Professional, screening and alerting for individual stocks, AI-powered ratings, fundamental technical analysis, real-time alerts. Stockalarm.io. I mean, at some point, we have to do a little more curation of the investment section, I think. how many actual advisors of the type who use the Kits' site will use something that's geared towards single stock analysis when the vast majority are allocating to funds and ETFs? Not really sure, but right now we keep adding to the investment data analytics section, and it's got like 60 applications in it. All right, more investment portfolio rebalancing, investment data analytics, amplify quantum risk tolerance and portfolio. I'm sorry, it's risk tolerance and portfolio risk assessment for RIAs. Need more of that. Replaces the standard deviation snapshot with simulations across millions of outcomes to get at tail risk. Then it scores it for client conversations. It's amplifyplatform.com. Gain 360, AI wealth management platform combining machine learning forecasting with CRM capability and a Salesforce integration. Gain360.io. That's in the portfolio management category. And rebalancing only, Zerspace, Zerrespace. Portfolio management with tax loss harvesting, automated rebalancing, a portfolio health score, and AI explanations of the metrics sold to both consumers and advisors. There's a problem right there. Consumers don't need rebalancing. Okay, client data gathering. FinPods AI, built by Matteo Hoke, a CFP and EA who runs an advice-only practice. 3 pieces: no login file collection from clients, automated extraction, and standardization from pay stubs, brokerage statements, and tax documents. Pricing runs $50 a month up to $900. That's a wide range. Client data gathering, FinPods AI. This one took a long time to place. We really didn't know where to put it. I think Michael's reaction to their tagline was he didn't even know what it meant, whatever they call their tagline for FinPods AI. But we did manage to put it in under client data gathering. Right. Custodial platforms, Alto, an alternative asset custodian, self-directed IRA custodian for private market assets. Now this looks interesting. I could use this. I'm not happy with my alternative asset custodian. Private deal room lets an advisor custody private structures a traditional brokerage can't hold, including SPVs, direct fund interest, and deals the clients source themselves. It sits alongside the primary custodian rather than replacing it. This is a really good idea. We could always use some more of these with better technology, better integration, better reporting. I'd like to see some better reporting in a mobile app. Michael also likes the business model, makes it easy for you to hold your own private deals, then they try to cross-sell you on their marketplace. Okay, specialized other, secure split, divorce case management. Why don't we see more divorce wealth management tools? 50% of matters end in divorce. This is the first one I've seen, divorce case management. Client intake, financial analysis, support calculations, settlement scenarios, and secure document storage in one system, $120 a month. SecureSplit.com. And some things don't make the map every month. And now we've got the services map where we can put some of these things like TAMPs and other types of services. So that's what goes over there. On the WealthTech integration score side, we're really ramping up our capabilities there. Every application that I just mentioned will get a score on EzraGroup.com, which you can check out any WealthTech score. Also check out the AI agents directory, which is new, and we're up to 75 agents over there. So if you're looking for some AI agents to help you out, check that out. It's under resources on EzraGroup.com. And that's a wrap for the August news. Thanks for listening. But before you go to our website, EzraGroup.com, scroll to the bottom of the homepage, and sign up for our newsletter. Once a month, you'll receive an email chock full of wealth management goodness, news, information, and updates. You will not be disappointed. Thanks again for listening, and talk to you all again next time.